But when comparing two or more stocks within the same industry that are direct competitors with very similar business models and similar prospects for the future, logic follows that their PE ratios should be about the same, if not exactly the same. If it's not, then there's an opportunity. It's like if there were two geese that each laid a golden egg per day, you'd buy whichever one cost less, presuming, of course, the eggs were the same size and same carat, same quality and all that business. The same stock that has a lower PE ratio among its peers is a better buy. And when I said, or else there's an opportunity, you see these opportunities all the time.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 43, How the Stock Market Works, Fundamentals. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. If you're already a listener, you can support the show with a paid subscription. When you do, you'll get video extra podcast episodes so you can get hands-on video training on things we talked about on the show. Subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash-secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar. And you'll get our unusual activity alerts on options income trades and so much more. The best part is your paid subscription helps keep this show on the air. To become a paid subscriber, just go to wealthbuildingpodcast.com, wealthbuildingpodcast.com, and choose your subscription level. That is on my Substack, and that is where you're going to get all those bonuses that I just mentioned. When I used to work at the exchange, whether it was trading on the floor or for the exchange in their education department, I had to leave my house. I know, it's a weird thing, right? I actually had to leave my house. Now I just run the market taker empire here from a room about 20 paces away from my bedroom. But I did. And when I worked in an office, I had to dress nicely too. Right now, I'm wearing a sweatshirt with a t-shirt under it. Doesn't really matter what I wear. That's the benefit to this being an audio-only podcast. But when I had to dress up, I would go and bring my clothes to the dry cleaners because, it was just easier. They were probably not going to mess it up, even though sometimes they did. And they would starch it and press it, and you pick it up, and boom, the clothes just look good. The shirts just look perfect, right? I don't have to iron. I don't know. It made sense to me. Then as I started investing my time in you, working with Market Taker Mentoring and doing this podcast and writing books and such, I would visit the dry cleaner less and less. Sometimes it would be like a couple of months later and they're like, oh, here you go. Here's your shirts. And I was like, oh, I didn't even realize I had shirts here. Thanks for not throwing them away or giving them to someone. Now I haven't been to the dry cleaner in a couple of years. They probably have some of my shirts. I should go find out. But one of the last times I went to the dry cleaners, it was kind of interesting to me. There was a new guy there, and he seemed to be the man in charge. And I was chatting with him, and he said, oh, yeah, well, I just bought this dry cleaners. And I thought to myself, well, that's kind of weird. And then I thought to myself, well, how does he know if he should buy it. And then, I just went through the obvious answers to that question. I mean, he would look at the books. He would look and see how much revenue the company took in over the last year or whatever, and probably the last couple of years before that. And he could verify that by looking at bank records. And he would look at what the expenses are. And he could verify that looking at payroll and rent and that. And he could just find out how much money the company earns in a year, typically, and decide from there how much to invest. Like if it earns $100,000 in a year and he's planning on owning it for a while, a decade or something like that, I mean, would it be worth it to maybe pay $100,000 for it? I mean, maybe. Once the first year's done, it's all gravy after that. There'd probably be some financing, so the math wouldn't really work like that. But you get the idea. It's some multiple or whatever of how much the company can bring in. Well, the stock market works exactly like that. Except it's so much easier. To buy a piece of a company, you don't need to hire a lawyer and go through all that legal rigmarole and register with the state or whatever. You just click a button and buy shares, and you become a part owner. Okay, well, the guy who bought the dry cleaners, he gets all that revenue. Well, that's because he is the sole owner. You actually do get a proportion of the revenue that a corporation that you bought shares in brings in. That is literally your money. Now, some of these companies have 1 billion shares or something like that, right? They can't just have like 100 million people come and knock on their door and say, oh, hey, I'm going to go shopping today. I'm going to withdraw some of my earnings here from the company. I just want to take out my share. Like, that would be madness. So they have to be organized about it. And they have the owners just vote on somebody to manage the company and make all those decisions on their behalf of whether to pay some of the revenues out in dividends, which is basically just giving the money back to the owner, or to reinvest it, take those earnings and grow the business. Somebody else makes those decisions for you. It is your money, but somebody's making the decisions of what to do with your money for you. And when you think about it in this way, gosh, it kind of makes everything kind of a lot less intimidating, doesn't it? Once you start digging into some of the numbers, it can start to feel intimidating again, but don't let it. It doesn't have to. It's really just as easy as the guy buying the dry cleaners. Look at the numbers, look at how much revenue, look at how much the expenses are, and consider how much of a multiple of that revenue makes sense to pay. So people who invest in stocks and look at these financial numbers, they call them fundamental investors or fundamentalists or value investors or intrinsic value investors. Some of the most famous investors of this nature are people like Warren Buffett. That's what he does. And what the best of them do is they calculate a company's intrinsic value. Now, that's a different use of the word than options intrinsic value. When it comes to fundamental investors' intrinsic value, that is taking a look at what a company should be worth. How do you know that? How are you supposed to know what a company should be worth? I mean, Google's approaching $4 trillion as I record this episode. How do we know it should be worth $4 trillion? Well, it's a lot simpler than you think. If we can look at what the earnings per share are for Google or whatever company for the past trailing 12 months, so 4 quarters of earnings, because as of right now, earnings are released every quarter. U.S. corporations are required to do that. In other countries, it's not that way, but U.S. corporations, they are. So you can just look at what the company owned per share and see what the price per share is and decide, hey, am I willing to pay this much times what the earnings are? Now, so it's a little bit different than that dry cleaner story I was telling earlier, because typically with stocks, investors tend to want to pay a multiple of what the trailing 12 months earnings have been. So if the company made, say, $20 a share. So if the company made, say, $10 a share over the last year, maybe roughly $2.50 on average for the last 4 quarters, made $10 a share, maybe they want to pay 10 times those earnings. Now, 10 times might seem like a lot to you, but here's the thing. Companies tend to grow their earnings. And so if it's 10 times what was made in the last year, if the company grows more, they get more earnings. And so the stock ends up going up to have the price catch up. Now, I'm getting a little bit ahead of myself. What I'm talking about is a simpler thing, the price to earnings ratio. But let's go back to the intrinsic value. They'll still do basically that. They'll say, hey, look, if the company earns this much on a regular basis, and I consider going forward what their growth rate may be, and I consider that that is my money, whether I get to keep it or just have somebody reinvested in the company for me, you can think about a stock like a bond. That's like blow your mind sort of thing, right? When I say a bond will pay regular interest payments. Like, let's just say you lend somebody money, like this is a bond. You lend somebody money, say $1,000, and they say that they're going to pay you, and they agree to pay you 1% a month. Well, that's 12% a year. What is 1% of $100? Well, that's $10, right? So $120 a year, that's 12% of $1,000. So if you know that if you lend this money, so basically like take this money out of your account and give it to somebody else, kind of like paying for a stock, but in this case, you're lending it to somebody, and you know that you're going to get $120 a year, 12% a year. Well, how much money would you lend to get that 12% a year? It gets a little bit trickier the more we get into it. And obviously, in high finance, things can get really tricky. But the underlying concept really isn't. It's just how much of a multiple of those earnings would I be willing to pay? Now, they'll take some other things into account, these investors. Now, value investors will take some other things into account in deriving what the intrinsic value is of the company, but that's really just the gist of it. I would recommend you reading some books if you want to get really, really great at value investing. And there's some good ones out there. And you can just go on Amazon and look at the reviews, of course. Or you can put a comment below here and just ask the question for what books I would recommend. And I would be happy to reply. But let me make the assumption that you want to make this a little bit easier. Okay. Me too. So an easier way to do this is just simply to look at a few financial ratios. And the one to start with, the OG, biggest, most widely known one, probably oldest used one for probably a couple hundred years, quite literally, is what we call the price to earnings ratio, or the PE ratio. And that is exactly simply what I was talking about. They take the last 4 quarters, so the trailing 12 months of earnings per share, and they take the price and divide it by those earnings. Price divided by earnings. A pure value investor will look for a very, very low PE ratio. something like 10 or lower, that's a really great ratio. And again, we have to think about what the company might do in the future. So what some people will do instead of using the trailing 12 months is they will use forecasted earnings. The problem with forecasted earnings is there's some of these forecasts and they're never going to be exactly right. In fact, sometimes they could be really wrong, but the past numbers, well, those, I mean, the numbers are the numbers. Another potential problem with them is that even with generally accepted accounting principles, GAAP, GAAP, bookkeepers at the companies who are keeping track of the numbers, they do have some flexibility in how they record certain entries. For example, a company might decide to write off a one-time big expense this quarter to make future earnings appear bigger. A company might record money spent on something as a capital expenditure. That means the purchase is not treated as an expense now, but rather an asset on the balance sheet to be expensed as depreciation over time. To understand what's really going on with the company's valuation, you really have to read the company's financial statements. You have to. This can be a real drag. I mean, it can be mind-numbing stuff. But fundamental analysis is definitely one of those things where the more you put into it, the more you get out of it. The more you learn, the more you earn. So you can use this PE ratio as a really great starting point to get value. Now, I mentioned that the value investors, they really want to see a PE ratio sort of around 10 or lower. But if we're looking at a growth stock, like a company like Google or Palantir or NVIDIA, for those of you who are listening to this at the end of 2025, those are some of the hot, sexy stocks that have really big PE ratios. Well, they have bigger PE ratios because they're expected to grow. The earnings is supposed to catch up to the price over time, which starts to get a little bit heady, but you know, I think it'll start making sense the more you start looking at it. The PE ratio is a useful tool from both an absolute basis as well as in comparing a company with its peers in the same industry. I already described basically the absolute basis, but when comparing two or more stocks within the same industry that are direct competitors with very similar business models and similar prospects for the future, logic follows that their PE ratios should be about the same, if not exactly the same. If it's not, then there's an opportunity. It's like if there were two geese that each laid a golden egg per day, you'd buy whichever one cost less, presuming, of course, the eggs were the same size and same carrot, same quality and all that business. The same stock that has a lower PE ratio among its peers is a better buy. And when I said, or else there's an opportunity, you see these opportunities all the time. I mean, one of the examples that I just wrote about in one of the later chapters in my book, we haven't got to the later chapters yet on the show, but was a comparison of AT&T versus Verizon. That's in one of the last chapters. Once the book comes out and you get a chance to take a look at it, you'll see what I'm talking about. But I mean, that's something that I did in my own investing. Okay, I liked AT&T, but AT&T's valuation got a little bit higher, among some other factors, which I think we'll get into during this episode. But Verizon had a lower valuation. It was a better deal. It was a cheaper goose that lays the same eggs. Now, another way to look at stock valuation is with what we call the price to book ratio. Book value is basically the owner's claim on the company. The formula for it is really, really simple. For those of you who know a little bit about accounting, in this case, we're looking at the balance sheet. We take the total assets of a company minus the total liability. And then if you want that on a per share basis, which we're going to want, we divide that by the outstanding shares, and that is the book value per share. The multiple an investor would be paying for the company's net assets is what the price to book ratio, or PB ratio, reveals. Stock price divided by book value per share. To me, the price to book value is a nice, straightforward way to think about what the thing you're buying is worth. So it's sort of like if you're going to buy that dry cleaners business from somebody. You could think about it in terms of how much money, the revenue, earnings, I should say, the company typically brings in a year and how much you pay for that stream, like the PE ratio. But you could think about it a different way, too. You could think about it as, okay, well, if I'm going to start this business, what do I need? Well, I need a lease or a building, and I need all this equipment, and I need all these customers who are loyal to the name that's on the door or on the sign, and all the chemicals that I have in the back room, and all the hangers, and all the machine things that you push the button and all the shirts go around in a circle on the hangers. All that stuff costs a lot of money. And so I could think about, hey, what am I paying for all this stuff to run the business? And note that there's one of the things that I mentioned is customers who are loyal to the name on the door or the sign. Those kind of things, they're a little bit harder to put an exact dollar value on. I mean, in some ways you can. But, when it comes to corporation, there's like logos and patents that are really hard to value. But people do value those intangible assets anyway. The company decides on what those are worth, and investors ultimately decide if the company's right. And this is the difference between tangible book value, which is just all the stuff that you can touch, versus book value, which also includes the intangible stuff, the tangible stuff and the intangible stuff. But this is a different way of looking at it. And it's not an alternate way of looking at it, a way to look at it differently. It's a way to look at it additionally. As far as the price to book ratio goes, the lower the stock price to the book value, the better. Most investors want the price to book ratio to be a much, much lower number than their threshold for the price to earnings ratio. A price to book ratio of like 1 would be considered low by a lot of investors. Now, there's a whole lot of hair splitting here. So those of you who are really good with fundamental analysis, I'm trying to make this pretty simplified. So don't beat me up here for saying, no, it should be 0.8. And also let me call your attention to the fact that some industries, book value is more important than others, and some it's a lot less important than others. Some, the number 1 might be really high or really low. Some, if it's 5, it's okay. Still, it's really simple to compare one company's price to book ratio with another that's in the same industry. And then it's the same as looking at the price to earnings ratio, the goose laying the eggs. This is just like buying the goose based on how much the goose weighs, the pounds and the age or something like that. Another really useful number is operating cash flow yield and price to operating cash flow. This is another way to consider the validity of a company as a stock investment. It's how much to pay for the cash flow it generates. Cash flow is thought of as a little more reliable in some ways than earnings in these measurements, because there's less leeway in how the accounting team can arrive at the numbers. Cash is cash. The cash that comes into the door, that flows in, you can't say $100 is actually $90, and we're going to use non-GAAP accounting. I mean, cash is cash. But cash can come from several sources. A company can borrow money from the bank to get cash. They can issue shares to get cash. They can sell off assets to get cash. Now, those sort of cash flows that come from financing activities or investments or whatever, they aren't as useful for this cash flow valuation objective. To understand the health of a business, it helps to know how much cash they generate from actual operations, from running the business. Cash generated from business activity is called operating cash flow. The operating cash flow, or OCF, some people might call it, the operating cash flow yield is calculated just by taking the operating cash flow and divide that by the price per share. Now that's yield. That's how much cash flow you get per price per share. You can flip that and look at it the same way as we'd be looking at PE, price to earnings, PB, price to book value, and we can put price on top. And that is called price to operating cash flow. That's another way to look at it. I mean, it's actually the same way to look at it, just the mathematical reciprocal. So, I mean, what's really the difference? Well, really, there is no difference. It's just personal choice. Because the PE ratio and the PB ratio both have price on top, the P to OCF, or price to operating cash flow, it just makes it easy because it keeps everything in the same family, the price on top ratios. Either way, the analyst, and in this case, that is you might not have thought of yourself as an analyst when you started listening to today's episode, but you are. And you can use these things we're talking about. And in fact, I'm glad I reminded myself, when we're talking about all these ratios and these numbers, and this is just an audio show and you're driving in your car or running or whatever it is you're doing while you're listening to this, I decided that I would do a video extra episode here for this and kind of lay these things out in a way that you can see it. I haven't decided if I'm going to do that just as a PDF to make it easier or if I'll actually do a video on it. But you're going to get an extra episode or extra content for all the paid subscribers, just so that you can more easily visualize this. The next ratio that I like to look at is the current ratio. An investor in a company wants to know how liquid a company is. Because what if all the numbers look pretty good, but they just don't have any cash on hand, and they've got to make payroll. They got to pay their bills. Well, if they can't pay their bills, get evicted from the shop that they're renting, they're not going to make any more money. Everything goes to hell in a handbasket. The current ratio is a helpful metric in determining this. So let's define a couple of terms. Current assets. So this is an accounting term. This is a balance sheet item. Current assets are things like cash or inventory and other assets that a company expects to convert to cash or use within 1 year or one operating cycle. You kind of have to throw that or one operating cycle in there because there are some companies whose financial statements are less about the year and more about the operating cycle. Like I think like builders, if I'm not mistaken, are more about the operating cycle. And then there's current liabilities. Those are short-term obligations that'll come due within 1 year or one operating cycle. So the current ratio, guess what that is? Well, it's a mathematically straightforward way to get a simple measure of assets to liabilities. To calculate it, all we do is divide the current assets by the current liabilities. If the current ratio is above 1, well, and just think about what 1 is, right? If all their assets are $100 million and all their liabilities are $100 million, 100 million divided by 100 million is 1. That means they have enough cash to pay their short-term liabilities. So if the current ratio is above 1 for most industries, the company would be perceived to be pretty good liquidity position. Though the farther above 1, arguably the better. Less than 1 implies that they have the potential to face a cash crunch, and that could be a red flag. But I always like to look at that one as well. And then there's another one that I think is important to talk about. That is dividends and dividend yield. So now we're kind of getting into something a little bit different, away from pure valuation, but still in some cases a really key financial number. A dividend payment is a payment that a corporation distributes to its shareholders. Investors choose to buy some stocks to collect dividends. Like sometimes that's their motivation. For me personally, a lot of the stocks that I invest in my IRA, they're more conservative. And some of them, not all of them, but some of them I do buy for their dividend yield specifically because I want to get that steady income. But not all companies pay dividends. Why? Well, we kind of talked about that a little bit. When some companies are young and in a growth phase, they need cash to grow. And even some companies, once they're not young but are still in a growth phase, they need cash to grow. Like right now, Amazon doesn't pay a dividend. That company's been around for a long, long time. Why don't they pay a dividend? Because they keep taking that cash and reinvesting it to grow and grow and grow. Now, companies can get money to grow by borrowing money. They can issue more shares, but they can also reinvest that cash flow that they earn from operations into the business. Like I talked about before, whether to pay a dividend or not is a decision made by the corporate officers that the shareholders elect. A key thing to know about dividends is that most companies that pay them, they do them in regular quarterly intervals. Now, there's no law or anything that says that you have to. In fact, there's one stock that I have that pays them yearly. But most of them do them in quarterly intervals. And they do that because there's a lot of people who, especially older people on fixed incomes, they buy a stock that's a very conservative company, steady, that they know is just going to keep paying a dividend and, in fact, raising the dividend year after year to keep up with inflation. And that's their whole reason for doing it. And so that's why a lot of companies like to pay them regularly, quarterly, because that just makes the stock a lot more attractive to a certain customer, if you will. Investor, I should say. Now, when you start looking at dividends, and yeah, the punchline here is we're going to be taking the dividends, dividing by the stock price and coming up with a yield. But we'll get to that in a second. Look, when I look at my Thinkorswim screen, I just leave it so that it shows the quarterly earnings figure right there on my chart. And it also shows the dividend right there on my chart. So one of the things that I'll just eyeball when I'm not too deep into the analysis yet is, oh, okay, this company pays a dividend. Are they earning more than what the dividend is? Because that can be a problem too. It's kind of like some people, and probably a lot of people, and I've been one of these people, but you're making however much a month, $7,000 a month, say, and you're spending on groceries and bills and credit card and going out to dinner and concerts, $8,000 a month. That's not sustainable. You can't live the rest of your life that way. You will go bankrupt. and so will the company. So the earnings has to be a certain percentage above the dividend payout. One might call that the dividend ratio. One of the best ways that I like to use wheel trades when it comes to dividends is to consider the dividend yield and then set my strikes according to where the yield is attractive for cash secured puts so that I can buy the stock at a good dividend yield, and where the yield loses its luster for covered calls so that I can sell the stock at the strike price where the yield's not so good. So, okay, now it's time. What is the dividend yield? So the dividend yield is how much an investor receives in dividend payments as a percentage of what they paid for the stock. Like earnings, it's customary to look at this as an annualized figure, but it's more customary to look at this as a price on bottom. So again, dividend yield is the annual dividends from the past year divided by the stock price. So if the stock's trading at $100 and over the past 4 quarters, the company paid dividends of $2, so $8 in the past year, that's $8 of dividends divided by $100 stock price is an 8% yield. The investor makes 8% on what they paid for the stock from dividends. This yield can be compared with that of another investment, again, like a bond or certificate of deposit, CD, or some other investment opportunity. Of course, the investor needs to consider the risk of that dividend stream becoming less or ending altogether because the company changes their dividend policy, which could happen if the company's having liquidity issues or something like that. And an investor needs to think ahead too. If the company has a history of raising their dividend once a year and the last 4 dividend payments were the same, well, then you would expect them to raise it going forward, and you would factor that into your math. Other investments, though, like treasuries, which is U.S. treasuries, are backed by the full faith and credit of the U.S. government, or bank deposits that are guaranteed by the FDIC, presuming the FDIC stays solvent, which since inception they have. Those have a much more guaranteed payout. But if you buy a stock of a company and the company ends up going bankrupt, well, not only do you lose the dividend, but you lose all the principal too. It's not, of course, a common occurrence, but I mean, it happens. So dividend investors buy when the dividend yields are high and the company is perceived to be of sound risk. As the stock price changes, though, so does the dividend yield. So imagine, again, stocks at $100 a share, and it pays, well, let's just say it pays $1.10 quarterly dividend. So that's a 4.4% dividend yield in this case. Well, if you can make 4.4% in buying a 1-year CD from your bank that's FDIC insured, that might not be a super attractive yield at that point. But if the investor also thinks the stock is undervalued, it might still be an attractive overall investment. So investors can profit from receiving dividends as well as stock price appreciation. But if the investors focus most intently on the dividend yield rather than stock price appreciation, he or she can probably find a better place to park their money if they can get 4.4% in a CD, something like that. So at a higher stock price, the dividend yield would be lower. The same dividend divided by a number higher, 110 divided by a number higher than 100 means that it's a lower yield. And at a lower stock price, conversely, the yield would be higher. So the way to think about it is you lock in the yield at the price you made the investment in your stock. Even though the yield changes as the stock price changes, your yield doesn't change because your cost stays the same. So a lot of dividend investors, they'll just look for opportunities and wait patiently for the stock to go down so that they can lock in a better yield. which is so counterintuitive to the way a lot of people think about the stock market. A lot of people who don't look at this stuff, they're like, oh yeah, this stock is really going up. That's great. I'm going to buy it. Oh, that stock went down. I better stay away from it. It's really the opposite when it comes to value investors and when it comes to dividend investors. But if the stock falls, why did it fall? Is it because of a downturn in its business? Because that's one thing. It may be a stock to avoid if all of a sudden they had really crappy earnings and they say, oh, geez, the CFO is cooking the books, or nobody's buying our products anymore. It turns out that this product isn't safe, so we have to pull it off the shelves. Like, that's a different story. But if it falls for seemingly no reason, then that's when a lot of investors will jump in and strategically wait for that to happen. Because most modern day economists believe that the stock market is not strongly efficient, meaning that the price of a stock isn't as related to the value of the company as one would think, which at first sounds like it negates what we talked about earlier, but no, it supports what we talked about earlier. You're looking for situations where the price is low compared with the value. You're looking to buy at a discount. You're looking to get a deal. You're looking for the price to be too low. And you're looking for the value to be higher based on the numbers, or in this case, the dividend yield to be higher based on the numbers. Good investors look for these fundamental opportunities. So when a stock falls in price, even though it's shown to be a strong company by its metrics, then it becomes a more attractive play in terms of dividend yield. And so on our next episode, what I want to talk about is setting strike prices based on some of these numbers. Now, look, when it comes to podcasts, I listen to a lot of podcasts myself. And you get good information, but usually you've got to take some sort of really expensive class or something to get great information. On the next episode, this is going to be some seriously good information. So be sure to listen to the next episode, because that about wraps it up for this one. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.